$867 billion. That is how much US Treasury debt China still holds. And according to documents leaked from the People's Bank of China, they are about to start dumping it. Not gradually. Not over years. In a coordinated, systematic liquidation that begins this week, the document is titled Strategic Reserve Reallocation, Phase 3 Implementation. It was obtained by a financial journalist in Hong Kong who has accurately reported Chinese monetary policy moves for over a decade. The document outlines a 36-month timeline to reduce China's treasury holdings by 80%. From $867 billion to under $175 billion. And Phase 3, the most aggressive selling phase, is scheduled to begin on Monday. This is not speculation. This is not a threat. This is an implementation schedule. China has decided that holding American debt is a strategic liability. They watched America freeze $300 billion in Russian assets. They watched the weaponization of the dollar. They learned the lesson. And now they are getting out. When $867 billion starts moving toward the exit, the consequences will be catastrophic for anyone holding dollars, bonds, or assets priced in the American currency. Interest rates will spike. The dollar will weaken. Inflation will accelerate. And the people who do not understand what is happening will watch their wealth evaporate in real time. Let me show you exactly what the document says, what the timeline reveals, and what you need to do before Monday arrives. To understand why China dumping treasuries is a nuclear event, you need to understand the relationship between the two largest economies in the world. Because for 30 years, that relationship has been the foundation of the global financial system. And it is about to end. The US-China economic partnership worked like this. China manufactured goods. America consumed them. China earned dollars from exports. China recycled those dollars by buying US Treasury bonds. America got cheap products and cheap financing. China got a reliable customer and a store of value for their surplus. This created a symbiotic loop. China needed American consumers to buy their exports. America needed Chinese money to finance deficits. Both sides benefited. Both sides were locked in. Neither could leave without hurting themselves. At its peak in 2013, China held $1.3 trillion in US Treasury debt. They were the largest foreign holder of American government bonds. Every Treasury auction, Chinese money showed up. Every deficit, Chinese financing covered. The U.S. government became dependent on Chinese capital to fund its operations. But the relationship has been deteriorating for a decade. Trade wars began in 2018. Tariffs were imposed. Technology restrictions followed. The rhetoric shifted from partnership to competition to confrontation. COVID accelerated the breakdown. Supply chain reshoring began. Decoupling became official policy. And then came February 2022. When the United States froze Russian central bank reserves after the Ukraine invasion, China saw its future. They saw that dollar reserves could be weaponized. They saw that holding American assets meant holding assets that could be seized at any time. They saw that the partnership was over and the trap was closing. Since that moment, China has been systematically reducing treasury holdings, from $1.1 trillion to $867 billion, a decline of over $230 billion in 3 years. They sold quietly. They avoided panic. They moved slowly enough that markets absorbed the selling without crisis. But according to the leaked document, the quiet phase is over. The gradual selling is finished. Phase 3 is acceleration, and it starts this week. Let me walk you through what the document actually says, because the details reveal the scope and urgency of what China is planning. The document is dated March 2025 and marked Internal Circulation Only, State Council Financial Stability Committee. It is organized into 4 sections covering strategic rationale, implementation timeline, reserve reallocation targets, and risk mitigation protocols. Section 1 is titled Strategic Rationale. It states explicitly that U.S. Treasury holdings represent unacceptable geopolitical risk in the current international environment. It references the freezing of Russian assets and states that similar measures could be deployed against Chinese assets with minimal warning. The document uses a phrase that translates roughly to financial hostage risk. It argues that every dollar of Treasury holdings is a hostage that America can seize at will. The recommendation is to reduce this hostage exposure to the minimum level required for trade settlement purposes only. The target minimum is stated as $150 to $175 billion, enough to cover 3 months of trade flows and emergency liquidity needs. Everything above that level is to be liquidated and reallocated. Section 2 is titled Implementation Timeline. This is where the document gets specific. It outlines 3 phases of selling. Phase 1 ran from 2022 to 2023. This was described as the preparation phase. China reduced holdings from $1.1 trillion to approximately $980 billion. Selling was gradual, timed to avoid market disruption. The goal was to test market absorption capacity and develop relationships with alternative buyers who could take the bonds off China's hands. Phase 2 ran from 2024 to early 2025. Holdings were reduced from $980 billion to $867 billion. The pace accelerated. China began routing sales through intermediaries in Belgium and Luxembourg to obscure the true source. The document notes that this phase revealed greater market fragility than expected. Foreign demand for treasuries has weakened significantly. Phase 3 begins now. The document specifies that accelerated liquidation should commence in the week of May 12, 2025. That is this week. The target is to reduce holdings by $150 to $200 billion within 6 months, another $200 billion over the following 12 months, and the remainder over the subsequent 18 months. The pace is aggressive, $25 to $35 billion per month in initial selling. This is roughly 10 times the pace of the quiet selling in previous phases. It will be visible. It will move markets. And according to the document, that is acceptable. Section 3 is titled Reserve Reallocation Targets. This reveals where the money is going, and it confirms everything we have been discussing on this channel. Gold. The document states that 40% of reallocated reserves should flow into physical gold. The target is to increase official gold holdings from the current 2,264 tons to over 5,000 tons within 5 years. This aligns with the gold backing requirements for the new BRICS settlement currency. Strategic commodities. Another 30% is earmarked for stockpiling oil, natural gas, copper, rare earth processing capacity, and agricultural resources. These are physical assets that cannot be frozen by foreign governments, BRICS nation currencies and bonds. 20% is allocated to diversification into currencies and government debt of BRICS partner nations, rupees, rubles, reals, and the new BRICS unit when it launches. Domestic investment. The remaining 10% is directed toward strategic domestic industries including semiconductors, artificial intelligence, and defense technology. Section 4 is titled Risk Mitigation Protocols. This section acknowledges that accelerated selling will cause market disruption. It instructs Chinese financial institutions to be prepared for volatility. It authorizes the use of currency intervention to stabilize the yuan if necessary, and it explicitly states that short-term market chaos is an acceptable cost of achieving long-term financial sovereignty. The document concludes with a statement from a senior official. It says, "The era of dollar dependency is ending. China must complete this transition before external circumstances force it upon us. Controlled departure is preferable to disorderly expulsion." So, why is China accelerating now? Why not continue the gradual selling that was working without causing crisis? There are 4 factors driving the urgency. Factor 1. The BRICS alternative is ready. For years, China has been building the infrastructure for a post-dollar world. The cross-border interbank payment system, bilateral currency swap agreements, the Shanghai Gold Exchange, the digital yuan. These systems are now operational. They can handle the volume. They can provide alternatives to dollar-based trade. China no longer needs treasuries as a reserve asset because they have alternatives that are outside American control. The BRICS summit in 2024 formalized the new settlement system. The BRICS unit, backed 40% by gold and 60% by member currencies, provides a non-dollar reserve asset. China can now sell treasuries and buy something else. The alternative exists. Factor 2. Taiwan tensions are escalating. The document references potential scenarios in the Taiwan Strait and the need to insulate Chinese assets from retaliatory sanctions. If conflict erupts over Taiwan, the United States will immediately freeze all Chinese assets within reach. Every dollar of Treasury holdings will be seized. Every Chinese bank account will be locked. The financial war will begin within hours of any military action. China is preparing for that scenario. They are moving assets out of the blast radius. They are ensuring that when the freeze comes, there is nothing left to freeze. The Treasury dump is war preparation disguised as portfolio reallocation. Factor 3. The U.S. fiscal situation is deteriorating. America is running $2 trillion annual deficits. The debt has exceeded $34 trillion. Interest payments are consuming more than the defense budget. The trajectory is unsustainable. China has concluded that U.S. Treasuries are a depreciating asset. The dollar will be debased. Inflation will erode purchasing power. Real returns on treasuries are negative. Why hold an asset that is losing value when alternatives exist? The document includes a projection. It estimates that the dollar will lose 30% to 40% of its purchasing power over the next decade due to deficit monetization. Holding treasuries means holding an asset designed to decline. Factor 4. De-dollarization has reached critical mass. China is not alone. Saudi Arabia is accepting yuan for oil. Russia is completely out of the dollar system. India is paying for Russian energy in rupees. Brazil and Argentina are trading in local currencies. The BRICS bloc now represents over 40% of global GDP. They are creating an alternative system. China is positioning to lead that system. And leading requires demonstrating commitment, demonstrating that China has fully exited dollar dependency. The Treasury dump is as much symbolic as financial. It is China declaring to the world that the dollar era is over, that the future belongs to those who hold real assets, not American paper. Major creditor nations have dumped Treasury holdings before, and every time it happened, the consequences for America were severe. 1971. The original Treasury crisis. Foreign governments, led by France, began demanding gold in exchange for their dollar holdings. They no longer trusted American fiscal policy. They wanted out. Nixon's response was to close the gold window, to end dollar convertibility, to default on the gold obligation. The result was a decade of inflation, dollar weakness, and economic turmoil. Gold went from $35 to $850. The dollar lost over 50% of its purchasing power. The creditor nations that exited early were rewarded. The ones who stayed were punished. 1987. Japanese selling scare. Japan was the largest treasury holder at the time. When trade tensions escalated and Japan threatened to reduce purchases, markets panicked. The stock market crashed 22% in a single day. The Federal Reserve was forced to intervene. The mere threat of Japanese selling caused a historic market collapse. 1988, Russian default cascade. When Russia defaulted on its debt, the contagion spread through global markets. Long-term capital management collapsed. The Fed coordinated an emergency bailout. A relatively small country's default nearly broke the global financial system. 1989, downgrade crisis. When Standard & Poor's downgraded U.S. debt from AAA to AA+, markets sold off sharply. Treasury yields spiked. The dollar weakened. This was just a rating change, not actual selling. The psychological impact alone moved markets. 1990. China's mini dump. China sold approximately $180 billion in treasuries over several months to defend the yuan. Treasury yields rose. The dollar strengthened but then weakened. Markets became volatile. This was a fraction of what the current document proposes, and it still caused significant disruption. Each historical example shows the same pattern. Treasury selling creates market stress. The larger the selling, the larger the stress. And $867 billion even sold over 36 months is orders of magnitude larger than any previous episode. China is the second largest foreign holder of US Treasuries after Japan. When they sell, someone must buy. If buyers do not appear, prices fall. Falling prices mean rising yields. Rising yields mean higher interest rates across the economy. This is not theoretical, this is mechanical, and the mechanism is about to activate. Let me explain exactly how China's treasury dump affects you personally. Because this is not distant geopolitics. This is going to hit your bank account, your mortgage, your retirement, and your purchasing power. First, interest rates will rise. Treasury yields are the foundation of all interest rates in the economy. When treasury yields rise, mortgage rates rise, auto loan rates rise, credit card rates rise, business loan rates rise. If China's selling pushes the 10-year treasury yield from 4.5% to 6%, mortgage rates will exceed 8.5%. Monthly payments on a median-priced home would increase by $600 or more. Housing affordability, already at historic lows, would collapse further. Variable rate debt becomes dangerous. If you have an adjustable mortgage, a home equity line, or variable rate credit cards, your payments will increase automatically as rates rise. Second, inflation will accelerate. To absorb the treasuries that China sells, the Federal Reserve may be forced to buy. This is called debt monetization. The Fed creates dollars to purchase bonds that the market will not absorb. Creating dollars is inflationary. The more dollars printed, the less each dollar is worth. Your grocery bill rises, your gas prices rise, your insurance premiums rise, your purchasing power evaporates. The document's estimate of 30% to 40% dollar depreciation over a decade translates to 3% to 4% annual purchasing power loss on top of already elevated inflation. Your savings are being taxed through debasement. Third, the stock market will face pressure. Rising interest rates are negative for stock valuations. Higher rates mean future earnings are worth less today. They mean debt servicing costs increase. They mean economic growth slows. If rates spike due to treasury market disruption, stock prices must adjust downward. Your 401k, your IRA, your brokerage account will decline. The wealth effect that has supported consumer spending will reverse. Fourth, dollar assets become risky. As China diversifies away from dollars, they are signaling that dollar assets are not safe. Other nations will follow. The dollar's reserve currency status will erode. If you hold 100% of your wealth in dollar-denominated assets, you are exposed to this transition. You are on the wrong side of the trade that China, Russia, India, and dozens of other countries are making. Fifth, social instability will increase. Higher prices, higher interest rates, lower asset values, reduced purchasing power. These are the ingredients of social unrest. Political polarization will intensify. Scapegoating will increase. The social fabric will fray. The treasury dump is not just a financial event. It is a catalyst for broader instability that will affect every aspect of life. So how do you protect yourself when the largest creditor nation begins dumping American debt? Here is the action plan for this week and beyond. Step 1. Understand the timeline and act before Monday. The document specifies that Phase 3 begins this week. By the time selling is visible in Treasury auction data, by the time CNBC runs headlines, the initial move will be over. Early movers will be positioned, late movers will be victims. Do not wait for confirmation. The confirmation is the document. The confirmation is the 3 years of steady selling that preceded this. The confirmation is every statement Chinese officials have made about de-dollarization. Step 2. Reduce exposure to long-duration bonds immediately. Long-term bonds are the most vulnerable to rising interest rates. A 10-year Treasury loses approximately 8% of value for every 1% increase in yield. A 30-year Treasury loses approximately 20%. If you hold bond funds, check their duration. Sell long-duration positions. Move to short-term Treasuries or money market funds if you must stay in fixed income. But understand that even short-term dollar assets are exposed to currency depreciation. Step 3. Accumulate physical gold and silver aggressively. China is converting Treasury holdings into gold. They are doing it because gold cannot be frozen, cannot be sanctioned, cannot be debased by a foreign central bank. You should do the same. If you have $500, buy 15 ounces of silver, physical metal in your possession. This is your insurance policy against everything the Treasury dump will trigger. If you have $2,500, buy 75 ounces of silver and a quarter ounce of gold. Diversify your metals. Build a foundation that exists outside the dollar system. If you have $10,000, buy 250 ounces of silver and 1 ounce of gold. Consider splitting storage between home and a private vault. You are building serious protection. If you have $50,000, allocate $15,000 to $20,000 to physical precious metals, 500 ounces of silver, 3 to 5 ounces of gold. Consider allocated storage outside the banking system. If you have $100,000 or more, target 25% to 30% in physical metals. Consider international storage for a portion, Singapore, Switzerland, jurisdictions outside American legal reach. China is diversifying geographically. You should too. Step 4. Reduce dollar exposure in retirement accounts. Your 401k and IRA are likely 100% dollar denominated. You cannot hold physical metals in most plans, but you can diversify. International stock funds, commodity ETFs, gold mining stocks, real estate investment trusts, any exposure that reduces pure dollar dependency. If your plan allows self-direction, consider a precious metals IRA that holds allocated physical gold and silver. Step 5. Lock in fixed-rate debt where possible. If you have an adjustable-rate mortgage, explore refinancing to fixed before rates spike further. If you have home equity lines, consider converting to fixed-rate loans. Fixed-rate debt is actually beneficial during inflation. You repay with cheaper dollars. Variable-rate debt is catastrophic. Your payments rise while your income lags. Step 6. Hold physical cash for transition volatility. Markets may freeze during the adjustment period. Electronic transfers may be delayed. ATMs may have limits. Banks may restrict access. Keep 2 to 4 weeks of expenses in physical cash. This is bridge liquidity for the transition period, not savings. Safety margin. Safety. $867 billion. Phase 3, starting this week, a 36-month timeline to exit the Treasury market. China has made their decision. The question is whether you will act before the consequences arrive. The Treasury dump will trigger a cascade. Rising rates, falling dollar, spiking inflation, market volatility, each domino hits the next. But there is one specific market that will be impacted first. One asset class that will move before everything else. It has signaled every major Treasury market disruption in history, and right now, it is flashing the most extreme warning signal in 40 years. I reveal exactly what that leading indicator is and what it is telling us in this video right here. Click it now. China's final move has begun. Make sure you are positioned before the cascade starts. I will see you there.